Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world, and today we're diving into Profusa Incorporated's latest financial puzzle. Let's just say digging into this one feels like trying to decipher a secret biosensor message. Spoiler alert, it involves a lot of numbers and some very interesting strategic shifts. Get ready, because this report is packed with intrigue and a few red flags we absolutely need to unpack. Now, before we jump into the deep end, if you love getting the real story behind these complex corporate filings, make sure to hit that subscribe button. You won't want to miss our future deep dives, and hey, we've built an awesome community over on Discord where we break down these reports together. So join us there, the link is in the description below. Alright, Profusa Inc. is filing a registration statement essentially saying they getting ready to sell a whole lot of their company stock. We're talking over 42 million shares here. Now, who is selling these shares and why is that important? Well, it is not the company selling new shares to raise money directly like a typical IPO. Instead, it is existing shareholders, primarily Ascent Partners Fund LLC, who are looking to sell their holdings. They were also selling some shares that were dished out to cover costs from a big business combination they completed back in July 2025. This means we're re-looking at a resale situation, not Profusa raising fresh capital directly from this specific offering. This whole process is overseen by the US Securities and Exchange Commission, or the SEC. They want to make sure investors have all the important details before they consider buying these shares. The company itself is Profusa Incorporated, focused on developing bio-integrated sensors, aiming to help people monitor their body chemistry. Think of it as a high-tech way to keep tabs on what is happening inside you. They're incorporated in Delaware, a common practice for many companies. This is a standard statement, meaning the SEC has reviewed the filing, and it will officially become effective on a date determined by the SEC. This report we were looking at is a preliminary version, a draft essentially, dated the 8th of October 2025. So the final details might still change a bit. Let us get back to those shares. This prospectus is about the resale of up to 42,594,000 and 48 shares of common stock. About 42.2 million of these shares are from Ascent Partners Fund LLC through a stock purchase agreement they have with Profusa. The rest, around 382,500 shares, were given to people who helped out with transaction costs for that big business deal. Profusa finished in July. It is also important to note that this is the first time Profusa has registered shares for Ascent to sell. They had an earlier filing in August 2025, registering about 9 million shares. This new filing is registering a significant additional chunk of shares. These shareholders can sell these shares in a few different ways, either on the open market at the current stock price or by making private deals. Profusa, stock is traded on the Nasdaq under the ticker PFSA. As of early October 2025, the stock was trading at a pretty low price, just 33 cents a share. That is a crucial data point for understanding the context here. And they are upfront about it. Investing in their securities comes with a high degree of risk. That is a standard warning, but given the stock price, it is worth paying attention to. Let's dive into the summary to get the big picture. So, Profusa Incorporated, formerly known as Northview Acquisition Corporation, completed a major business combination on the 11th of July 2025. This means they essentially merged with another company, Profusa Inc., the California one, and changed their name. The actual Profusa business, the one developing sensors, has been around since 2009. Their goal is to create sensors that can be integrated with the body to provide real-time health data. Their technology, called Lume, is designed to be a part of the body, sending out important health information. Their first product, Lume Oxygen, has already gotten approval in Europe, and it is meant to track oxygen levels in tissues, which can be super helpful for things like wound care and surgery recovery. But the real focus for future growth seems to be on Lume Glucose. This is a continuous glucose monitor, or CGM, designed for people with diabetes. The key innovation here is that it is a tiny gel injected under the skin that can last for months, potentially replacing finger pricks or the need for frequent sensor changes with current CGMs. This could be a huge deal for diabetes management. Now, how are they funding all this? They got something called a committed equity facility, or a committed equity financing with Ascent Partners Fund, LLC. This is essentially an agreement where Ascent is committed to buying up to $100 million worth of Profusa as stock over time, whenever Profusa decides they need it. Profusa can choose when and how much stock to sell to Ascent. up to that $100 million limit. How it works is Profusa gives Accession a notice saying, we need to sell some shares, and Accession agrees to buy them, typically at a price based on the stock's average trading price over a certain period, usually at a discount. Specifically, Profusa sells the shares to Accession at 97% of the lowest average stock price over a valuation period. This means there is always a built-in discount for Accession. Here is a really interesting twist. Profusa intends to use the money they get from selling shares to Accession to buy Bitcoin. Yes, you heard that right. Bitcoin, they only do it if their cash balance is above $5 million. Otherwise, they use the money to boost that cash balance first, then buy Bitcoin with the rest. This strategy is quite unique and definitely adds another layer of risk. In terms of the offering itself, Profusa's outstanding common stock as of the 8th of October 2025 was about 41.7 million shares. After potentially issuing all the shares registered here for resale, that number could jump to over 83 million shares. That is a substantial increase. This table here shows us that if all these shares are sold, it could significantly increase the total number of shares of Profusa's stock out there. As expected in any SEC filing, there is a whole section dedicated to risks, and Profusa has quite a few to consider. First, risks associated with that stock sale agreement with Accession. They can't truly predict how many shares they'll sell or how much money they'll actually get. They explicitly mentioned that selling stock to Accession will dilute the ownership of their current shareholders, and the possibility of these sales could cause the stock price to drop. This is a common risk with these types of financing agreements, as the market knows more shares are coming. And then there is the Bitcoin strategy. They're clear that they'll use the proceeds to buy Bitcoin, and they acknowledge that Bitcoin's price is highly volatile and will likely continue to be. This is a significant risk factor. The price of Bitcoin has swung wildly, and pinning your company's financial strategy to it is, well, risky. Beyond the financing, they've got operational risks. This is a big one. Profusa states there is substantial doubt about their ability to continue as a going concern. This means they're questioning their ability to stay in business without running out of money. This is a serious red flag that indicates potential financial instability. It also signals difficulty in getting more funding in the future. They also point out their limited operating history and that they've been losing money since they started. This is typical for early stage companies, but it adds to the overall risk profile. Then there are regulatory hurdles. They need FDA approval for their products, and there is no guarantee they'll get it. Failure to get these approvals could really hurt their business. Intellectual property is also a concern. They could face lawsuits for infringing on others' patents, or their own patents might be challenged. They also mention environmental, social, and governance, or ESG regulations could make their supply chain more complicated, and the current global economic and political uncertainty makes it hard to predict product demand. Let's circle back to that Bitcoin strategy, because it is a major theme here. They are fully aware that holding Bitcoin is risky. They reiterate Bitcoin's volatility and how it will affect their financial results and their stock price. Imagine their stock price tied to the wild swings of Bitcoin. That is a recipe for big movements. And the legal and regulatory landscape around digital assets is still very uncertain, which adds another layer of risk. This is important. Their past financial statements don't really show this Bitcoin strategy because it is new. But going forward, Bitcoin could become a huge part of their assets and cause big swings in their earnings. They're putting a lot of eggs in the Bitcoin basket, and they admit this concentration makes the risks even higher. Now, let's look at some of the pro forma, or projected financial information. This section tries to show what the combined company's finances would look like if the merger had happened at an earlier date. Looking at the assets under the pro forma combined column, you see cash and cash equivalents to be over $14 million. That is a positive sign, though it needs to be compared to their liabilities. Their total assets are listed as about $14.6 million. Now, for the other side of the balance sheet, their total liabilities are over $36 million, and they have a significant stockholders deficit. This negative number for total stockholders' equity means that the liabilities outweigh the assets, which is not a good sign. Looking at the income statement for the 3 months ending the 30th of June 2025, their revenue is zero. That is right, zero revenue. While they have some grant revenue, their actual product sales are not generating income yet, and they reported a net loss of over $5 million for that period alone. The weighted average shares outstanding for common stock is around 5.2 million. For the entire year ending the 31st of December 2024, they reported revenue of just $100,000, again, minimal, and a net loss of over $9 million. These numbers paint a picture of a company still very much in the development and funding phase. This section is management's chance to explain the numbers. They admit to recurring annual losses and a need for additional funding. They identify as a clinical stage company, meaning they're beyond the very early research, but still need FDA approvals and market establishment. They've been losing money since day one and expect that to continue for a while. Under the business section, they detail their products, Lume Oxygen and Lume Glucose, and their market potential. The addressable market for diabetes management alone is massive. Over 500 million people in the US and EU. Their growth strategy involves launching Lume Oxygen in Europe soon, followed by Lume Glucose, and then expanding to other analytes and data partnerships. Lume Oxygen, their CE's approved product, aims for wound care and critical limb ischemia management. Lume Glucose, their big hope for diabetes, is still very much in development and not yet approved for sale in the US. They've got a pretty extensive patent portfolio, which is good for protecting their innovations. They own 20 issued US patents and many more internationally. Competition is fierce in both the oxygen monitoring space and especially in continuous glucose monitoring. Giants like Dexcom, Abbott, and Medtronic are already well established in the CGM market. Profusa's hope is that their longer lasting, potentially cheaper, and easier to use sensor will give them an edge. They're navigating a complex regulatory landscape, especially with the FDA. Getting approvals is a long, expensive, and uncertain process. They've got IDA applications approved for studies, but the path to market for Lume Oxygen in the US and Lume Glucose everywhere is still a major hurdle. Let's look at who actually owns the company. Northview sponsor ILC holds a significant chunk, about 22.4%, and Ascent Partners Fund LLC, the same group involved in the equity facility, holds around 8.2%. Ben Huang, the CEO and chairman, holds a smaller stake, about 2%, along with his spouse. Hold on. Fred Nextel, the CFO, holds a massive 21.5% stake. This is interesting given he is the CFO and a director. This might indicate a larger personal investment or a different compensation structure. This is a significant percentage for an executive. And Jack Stover, another director, also holds a very large portion, around 20.7%. This implies that a substantial part of the ownership is concentrated among a few key individuals, including the CFO and a director. Profusa has several agreements with related parties, including investors like Taisley. They've also got a term sheet for a joint venture in the Asia-Pacific region. There is this Taisley convertible debt, where Taisley, a related party, loaned Profusa money that could convert into equity. The fair value of this debt has fluctuated quite a bit, showing up as approximately $2.5 million in liabilities as of June 2025. Back to the shares being offered for resale. Ascent Partners will be selling a large portion of these shares. They are considered an underwriter in this context. This means they are taking on some risk in facilitating the sale to the public. The expenses for this whole registration and distribution process are estimated to be around $147,000, mostly paid by the company. Their common stock has 1 vote per share. They've got a good number of authorized shares, which gives them flexibility for future financing or acquisitions. Their corporate structure includes anti-takeover provisions, common for Delaware companies, designed to prevent hostile takeovers. This can sometimes make it harder for shareholders to influence company direction. For their sole named executive officer, Ben Huang, his salary for 2024 was $470,000, with no bonuses or stock awards that year. Looking at the summary compensation table, you can see that Ben Huang's compensation was $470,000 in both 2024 and 2023. It is notable that there are no stock options or bonuses listed for him in these years. This could mean compensation is heavily weighted towards salary, or that equity awards are handled differently. This table shows ownership after the business combination. Ben Huang owns about 2%. Fred Nextel, the CFO, still holds that significant 21.5%. And Jack Stover, the director, holds about 20.7%. Northview sponsor ILC is the largest shareholder with about 22.4%. And Ascent Partners Fund LLC holds 8.2%. It is clear that a few entities and individuals hold a very large portion of the company S stock. The auditors, Markham LLP, clearly state there is substantial doubt about Profusa's ability to continue as a going concern. This ties back to those significant losses and the need for more funding. Let S look at the balance sheet for Profusa as of the 31st of December 2024. Their total assets were just over $3 million. However, their total liabilities were much higher at nearly $57.2 million. And they have a huge accumulated deficit of over $124 million. This confirms that massive imbalance between what they owe and what they own. When we look at their operations for the year ending the 31st of December 2024, revenue was just $100,000, while operating expenses were $4.6 million. This resulted in a net loss of over $9.2 million. The numbers show a company heavily reliant on external funding, with a long road ahead to profitability. Now, what is my take on all this? Profusa Incorporated is definitely in a high-risk, high-reward category. Their biosensor technology, especially for continuous glucose monitoring, sounds promising and addresses a massive market. The potential for Lume Glucose to offer a long-lasting, less invasive solution is a real game changer, if they can execute. However, the risks are significant. The company is burning through cash, has a very limited operating history, and faces intense competition. The fact that their auditors have serious doubts about their ability to continue as a going concern is a major red flag that cannot be ignored. Adding Bitcoin to their treasury strategy introduces another layer of extreme volatility and regulatory uncertainty. It is a bold move, but one that could amplify both their potential gains and their potential losses. The large ownership stakes held by the CFO and a director, alongside the sponsorship from Accession partners who are selling a large number of shares, suggest a complex web of relationships and incentives at play. Are these insiders betting heavily on the company's success or positioning for an exit? In conclusion, Profusa is a company with ambitious technology in a growing market, but a precarious financial situation. Investors need to be extremely cautious and understand the high level of risk involved, especially with the Bitcoin strategy and the ongoing need for funding. This is not a bet for the faint of heart. What did you think about Profusa's strategy, especially the Bitcoin part? Let me know in the comments below. If you found this deep dive valuable, smash that like button, and definitely subscribe so you don't miss our next corporate dissection. And most importantly, join our Discord to keep the conversation going. Thanks for watching, and I'll see you in the next one.